Hey everyone, welcome back. Ready to dive into some short-term trading strategies?
Always ready.
Well, today we're taking a deep dive into a book that really challenges conventional wisdom.
Oh, yeah. Which one?
Short-Term Trading Strategies That Work by Larry Connors and Cesar Alvarez.
Those guys always bring the heat when it comes to market insights. They don't mess around. What's the big takeaway?
Well, they really emphasize the importance of going against the grain. Not just following the herd.
So thinking differently, kind of like a contrarian approach.
Exactly. They really push back against some of those common trading myths.
I'm all ears. Like what?
For instance, they debunk this whole idea of chasing breakouts. Jumping on a stock when it's surging upward, hoping to ride the wave.
Oh, yeah, that classic FOMO. Fear of missing out. I've definitely fallen into that trap before.
Right. It seems so intuitive, like buy high, sell higher.
But it turns out that's actually statistically a losing strategy.
You're kidding. For real.
Yep. Their research shows that since 1995, buying during pullbacks, those dips in a stock's price actually outperformed buying breakouts.
So instead of chasing the hype, we should be looking for those moments of fear in the market.
You got it. When everyone else is selling, that's when we should be buying.
That's wild. So even during a massive bull market like we saw from 1995 to 2007, blindly buying breakouts would actually lost you money.
It's crazy, right? But even during that incredible run-up, buying pullbacks was the statistically smarter move.
Okay, so we need to think differently, be contrarian, look for those pullbacks. What else?
Well, Connor and Alvarez, they lay out 6 key rules for smart trading. These are like the foundational principles for their entire approach.
Okay, let's unpack a few of these golden rules.
Okay, well, one of the most important is Rule 3. Always buy stocks that are trading above their 200-day moving average.
Got it. So basically, don't buy stocks that are trending downwards.
You got it. Think of that 200-day moving average as a trend line. It basically tells you the overall direction of the market for a particular stock.
So it's like a long-term weather forecast for a stock. If it's above that line, it's sunny skies, good weather for investing.
Yeah.
But if it drops below, there might be a storm brewing.
I like that analogy. And trust me, when a stock dips below that 200-day moving average, things can get ugly fast.
Any examples of that? A cautionary tale to really drive home the point.
Oh, there are plenty. The book talks about some major companies that experienced catastrophic losses once their stocks dipped below that key trend line.
Okay, I'm listening.
Think Bear Stearns, Washington Mutual, even big names like United Airlines and Citigroup.
Ouch. Those are some heavy hitters. I'm definitely seeing why that 200-day moving average is so important. So what's another rule that can give us an edge?
Well, let's talk about the VIX.
The VIX. You mean the volatility index?
That's the one. It's basically a fear gauge for the market. It measures how anxious investors are feeling.
Right. I've heard of that. But how do we actually use it to our advantage?
Well, Connors and Alvarez have this brilliant strategy called the VIX 5% rule. They found that when the VIX is 5% above its 10-day moving average, it's a great time to buy.
Wait, so we're buying when fear is high. Isn't that counterintuitive?
It might seem that way, but think about it. When fear grips the market, prices tend to drop.
Oh, okay. I'm starting to see it.
It's like a sale at your favorite store. And on the flip side, when the VIX is 5% below its 10-day moving average, that's a signal to sell.
So we're buying when others are fearful and selling when they're feeling greedy.
Exactly. It's all about using those waves of emotion in the market to your advantage.
I like it. Okay. I'm starting to see the power of thinking differently and using data to guide our decisions. What other counterintuitive wisdom do these guys have?
All right, are you ready for this one? They actually suggest holding positions overnight.
Hold on. I thought the whole point of short-term trading was to get in and out quickly, like within the same trading day.
Right. That's what most people think. But Connor and Alvarez discovered that statistically, the market makes most of its gains overnight.
Really? But isn't it risky to hold positions overnight? I mean, what if some unexpected news breaks or a global event shakes things up?
Of course, there's always risk involved, but their data is pretty compelling.
Oh, how so?
Well, the book shows that even during periods of extreme uncertainty, wars, 9/11, even the 2008 financial crisis, buying at the close of the market and selling at the open the next day actually outperformed day trading.
Wow, that's pretty surprising. So even with all the potential risks, it's statistically better to ride out the night.
It seems counterintuitive, but that's where the edge lies. It's about recognizing those statistical patterns that most people miss.
Okay, I'm definitely going to need to rethink my entire approach to short-term trading.
Well, before we go down that rabbit hole, let's address the elephant in the room. Stop loss order.
Stop loss orders. Everyone talks about those.
Right. They seem crucial for managing risk.
So what's the problem?
Well, Connor and Alvarez actually found that relying too heavily on stop-loss orders can lead to missed gains and unnecessary losses.
Wait, seriously, how is that even possible?
Think about it. The market is constantly fluctuating. Those little dips and spikes throughout the day are perfectly normal. But if you set a tight stop-loss order, you might trigger a sale during a temporary dip, even if the stock rebounds shortly after.
So you end up missing out on the upswing just because of a momentary blip.
Precisely. It's like jumping ship prematurely when the boat hits a small wave, even though it's still headed in the right direction.
Okay, so are they saying we shouldn't use stop-loss orders at all?
It's not that simple. The authors acknowledge that stop-loss orders can provide psychological comfort, especially for newer traders.
That makes sense. I've definitely felt that way before.
But they emphasize the importance of being strategic, not relying on them blindly.
So it's all about finding that balance between managing risk and maximizing potential gains.
Exactly. These rules aren't about handing you a set of rigid commands, but rather a framework for making more informed decisions.
I like it.
It's about understanding the statistical nuances of the market and using them to your advantage.
I'm really starting to see how these pieces fit together. So where do we go from here?
Well, let's talk about how to capitalize on those moments when the market seems to go haywire. You know, those periods of intraday chaos. They're actually ripe with opportunity.
Okay, I'm definitely intrigued. Let's dive into the chaos.
You know, when things get wild in the market, that's where the real opportunities lie.
It's funny you say that because most people see that volatility as a bad thing. Something to avoid at all costs. Like run for the hills, right?
It's understandable. But Connor and Alvarez, they're all about embracing that chaos, finding the hidden gems within those crazy price swings.
So we're not shying away from those moments when the market seems to be losing its mind.
Absolutely not. Think of it like this. When everyone else is panicking, selling off their stocks, that's when you can often find the best deals. It's like a fire sale for stocks.
So those intraday plunges, those sudden nosedives, those are actually buying opportunities.
In many cases, yes. Those sudden drops are often driven by pure fear and panic. Not any fundamental change in the company. It's like everyone's overreacting to some small piece of news or a temporary blip in the market.
Okay, so the key is being able to distinguish between those irrational dips and a real sign of trouble.
Exactly. And the book provides you with a bunch of tools and strategies to do just that.
Well, speaking of tools earlier, we were talking about the 2-period RSI. And I'm still trying to wrap my head around how to actually use that effectively. It seems so different from the traditional 14-period RSI.
It is different, and that's the point. The 2-period RSI is specifically designed to capture those short-term market swings. You know, those super quick shifts in momentum that the 14-period RSI often misses?
So it's like a high-speed camera for the market, allowing us to see those subtle shifts in momentum.
Yes, perfect analogy. And remember, those extreme readings on the 2-period RSI, that's where the magic happens. So when it dips below 2, that's a signal that the market is oversold. Think of it like a rubber band that's been stretched way too far.
It's bound to snap back.
Exactly. And that snapback, well, that's our opportunity to buy. Their research shows that stocks with those super low RSI ratings tend to outperform the market significantly. And on the flip side, if the 2-period RSI surges above 98, that's our warning sign. It means the market's probably overbought and likely to correct.
Okay, so it's our early warning system helping us navigate those choppy waters.
Precisely. And you know what? Connor and Alvarez, they actually take this concept a step further with what they call cumulative RSIs.
Cumulative RSIs. Okay, I'm intrigued. What are those?
Okay, imagine you're tracking the daily temperature for a whole month. Now, instead of just looking at the temperature on a single day, you also calculate the average temperature for the past week, 2 weeks, even the entire month.
Right, to get a broader perspective, see the bigger picture, the overall trend.
Exactly. So cumulative RSIs work in a similar way. Instead of just looking at the 2-period RSI on a single day, you add up the RSI values for the past several days, giving you a cumulative picture of the market's momentum.
So we're basically looking for patterns and trends in those RSI readings over time.
You got it. And Connor and Alvarez have identified some key thresholds for those cumulative RSIs that signal strong buying opportunities.
I'm listening.
So, for example, they found that when the cumulative RSI dips below 35, that's a powerful signal to buy.
And then we hold that position until
until the two-period RSI crosses above a certain level, like 65, for example. That way, we're capturing most of the upward move and selling into strength.
So we're using the cumulative RSI to spot the entry point, and then the two-period RSI to guide our exit.
Bingo. It's a really dynamic strategy that combines both the long-term and short-term perspectives.
Wow, the beauty of this data-driven approach is that it takes out so much of the emotion and guesswork from trading.
That's exactly the point. But of course, we can't ignore the other side of the coin, short selling.
You're right. Up to this point, we've been talking about strategies for when the market's going up. But what about those times when the market takes a downturn?
Don't worry, Connor and Alvarez have got you covered. They've got a whole chapter on short selling strategies specifically designed for bear markets.
Okay, good, because short selling, that can be a pretty risky game if you don't know what you're doing.
You're telling me. But their approach is all about minimizing risk and maximizing your potential.
Well, how do they do that?
One of their strategies is called the S&P short strategy, and it's surprisingly simple. So first, you got to make sure the S&P 500 is below its 200-day moving average.
Right, makes sense. So we only want to be shorting when the overall trend is down, not up.
Exactly. And then you wait for the market to close up 4 more days in a row.
Okay, so we're looking for a bit of a bounce, a little rally within that overall downtrend.
You got it. And as counterintuitive as it seems, that little short-term rally actually sets up a better opportunity to short the market.
And then we sell short at the close of that fourth day.
Right. And then hold that short position until the S&P 500 closes below its 5-day moving average.
Got it. So we're basically riding that downward momentum until it starts to show signs of weakening.
You got it. And their research shows that this strategy can be very successful and generate some substantial profits even in a bear market.
So we've covered a lot of ground here. Debunking common trading myths, exploring specific strategies for bull and bear markets. But there's one crucial element we haven't touched on yet: the psychological aspect of trading.
Ah, the mental game. That's where everything really comes together or falls apart.
Exactly. You can have all the best strategies in the world, but if you don't have the right mindset, you're setting yourself up for failure.
You know what? There's actually a whole chapter dedicated to this in the book, packed with insights and real-life experiences of successful traders. It goes way beyond just theory.
So what are some of the key takeaways? What do we really need to know about mastering this whole mental game of trading?
Well, for starters, they emphasize the importance of having a plan. And not just for your trades, but for how you'll handle the ups and downs of the market. Because let's face it, trading is a roller coaster.
Oh, tell me about it. It can be an emotional roller coaster.
Exactly. And if you're not prepared for those wild swings, you're going to start making impulsive decisions that will cost you money.
So it's about having the discipline to stick to the plan, even when you're feeling scared or greedy.
Precisely. Fear can paralyze you from taking any action, while greed can lead you to chase after those bad trades.
It's like those emotions completely hijack our rational thinking.
You said it. And they also talk about the importance of learning from your mistakes, because let's face it, we're all going to make them, especially in the beginning.
I've definitely made my fair share, that's for sure.
The key is to not let those mistakes define you, to analyze what went wrong and adjust your approach.
It's all part of the learning process.
Exactly. And you know what? They even include an interview with a former Navy SEAL in the book.
Oh, wow, for real. What does a Navy SEAL have to do with trading?
Well, his name is Richard Mitovich, and he talks about applying those principles of a warrior mindset to the world of trading. SEALs, they're trained to stay focused, even in the midst of all this chaos and uncertainty.
And they're able to apply that to the market.
He talks about how having the guts to make decisions and the courage to actually take action, it's about that commitment to see things through to the end.
So we need to approach trading with the same level of discipline and determination as a Navy SEAL. Wow, I like that.
Right. Trading isn't for the faint of heart. It requires mental toughness, resilience, and the ability to push through those challenges.
I'm really starting to see how much more there is to trading than just the technical stuff.
I know, it's really about developing the right mental habits for long-term success.
This has been such a thought-provoking conversation. It feels like we've only just scratched the surface of this book.
Definitely a lot more to explore. We could spend hours dissecting all the nuances.
Okay, so as we wrap up this part of our deep dive, let's bring this all back to you, the listener, and your own trading journey.
It's easy to get lost in all this theory and data, but ultimately it's about applying these insights to your own trading decisions.
So as you listen to this, I want you to really think about everything we've discussed. what are some of the key takeaways that you can actually start implementing in your trading today?
Maybe it's the importance of thinking differently, buying when others are fearful. Or perhaps it's using the two-period RSI to spot those market swings.
Or maybe it's about recognizing that stop-loss orders aren't always the answer, or that holding positions overnight might actually be the better move.
The choice is yours. But the point is, take action. Don't let this knowledge just sit idle.
It's not enough to just understand these concepts. You got to use them. Now, are you ready for the final part of our deep dive? Right, so we've really dug deep into short-term trading strategies that work today, challenged some of those old assumptions, hopefully giving you some fresh tools and perspectives to use as you navigate the market.
Yeah, definitely. And, one of the things that really stuck with me from this book is the importance of mindset.
Yeah. That whole warrior mindset thing we were talking about earlier, right? Approaching trading with that same level of discipline and focus as a Navy SEAL.
Exactly. It's like having this unwavering determination to succeed no matter what. Even when the market throws you those curveballs, those unexpected twists and turns.
Because trading can be brutal, right?
Yeah.
Let's be honest. There will be losses. There will be setbacks, moments when you might even want to just throw in the towel, walk away from it all.
Oh, absolutely. But you know what? The traders who really succeed, the ones who consistently come out on top, are the ones who can push through those tough times, stay focused on their goals. They don't let fear and greed, those big emotions, run the show.
Right. It's about having a plan, sticking to it, managing risk, staying disciplined, even when things get a little crazy.
Yeah, and it's about constantly learning, adapting, refining your approach. Because the market's always changing, right? So you got to change with it. You got to evolve with it.
So as we wrap up this deep dive into short-term trading strategies, I want to leave you with a little challenge.
Oh, okay. I like challenges. Lay it on me.
All right, think back to everything we talked about today. What are your goals when it comes to trading? What are your targets in the market, so to speak?
Yeah, and what weapons are you going to use to hit those targets? Are you going to focus on buying during pullbacks? Or are you going to use the two-period RSI? How about the VIX 5% rule?
You got a whole arsenal of tools at your disposal now. But the key is to actually use them. Don't let all this knowledge go to waste.
Yeah, knowledge is power, but only if you put it into action.
Right.
Trading success, it's not about luck or some magic formula. It's about having a plan, sticking to a data-driven approach, and having that mental fortitude to see it through to the end.
You got to become a market warrior, equipped with the knowledge, the strategies, and the right mindset. That's how you conquer the complexities of the trading world.
Couldn't have said it better myself. So go out there, make it happen. We believe in you.
And that's a wrap on today's deep dive. Thanks for joining us, and happy trading, everyone.